Hey everyone, in today's video, I'm going to be talking about my 3 worst performing stocks in my entire stock portfolio. We're going to be going through what are these stocks, how down I am on each of them, and then go into a bit more background on each of these companies, a bit more about their businesses, why they're down so much, and my thoughts on these companies right now and going forward in terms of am I buying more, am I just holding, am I looking to sell? So this should be a bit of a different type of video for you guys here today. If you like this kind of content, be sure to give this video a big thumbs up. It really does help get these videos out to more people, and we'll jump right into it. As you can see, the first worst performing stock in my portfolio from the screen here is Northwest Healthcare. This one has done terribly lately. You can see here in one of my accounts here, I'm down over 50%. I'm similarly down in my Wealthsimple account as well, I think about 50%. So it's definitely not been a good performer for me, getting cut in half. You can kind of see the stock chart here over the last 5 years. Let's take a look. They were holding up pretty well at around $12, went all the way up to around $14. So it looked like in addition to the dividend, I was also getting some capital appreciation, some net asset value increases year over year. And that all came to a stop recently here. First, late last year, dipped down to about the $10 range, and then it just got cut in half this year. So just terrible performance on this one. $1.2 billion market cap, currently paying out 36 cents a share. They just cut their dividend hugely. So 36 cents a share on a $5 share price is about a 7% dividend yield. They used to pay out about 80 cents a share, which at the current price was closer to about a 15-16% yield. So going into Northwest Healthcare stock a bit more here, you can see their overall business overview here. They own over 200 properties, and they obviously own assets here in the healthcare space. So they own a lot of hospitals, but they also own medical centers, like buildings primarily renting to dentists and doctors and physicians and stuff like that. They own those types of assets. And they also own assets all over the world. So you can see initially was a Canadian company, but expanded very heavily with acquisitions in Australia, in Europe, in Brazil. And you kind of get a good glimpse of some of the types of assets they own there on the slide. Going into their net operating income mix here, you can see by region, they're pretty well diversified here. You got like the Americas between Canada and the US at about half their business, Australia and Asia at about a quarter, and then Europe at about a quarter. And you can kind of get a sense of their relationships and tenants and whatnot. Very intertwined with the healthcare community globally, and also with lots of governments globally as well. If we look at a couple of benefits of investing in this REIT, at least from a investor sell deck point of view, it's lots of the same benefits that you have of investing in the underlying healthcare sector, right? You got obviously a type of product or a type of service that's going to be needed always, and especially with lots of baby boomers and whatnot around the world getting older, especially in the US, they're going to rely on this kind of infrastructure. You also have a very niche sector here where it's not necessarily someone who owns all the hospitals around the world or owns all the medical facilities around the world. By country and by region, it tends to be owned and managed differently. So there's potential opportunities for scale, synergies, reapplications, and whatnot. And then obviously the defensive nature of the business. No matter what's happening, recession, no recession, these assets will still be used. It's not like retail space that may get less foot traffic during a bad time. Unfortunately, people still need to use hospitals during bad times. So that kind of guarantees the underlying usage of the asset class. So that's kind of some of the reasons why lots of people first did invest in Northwest Healthcare, and they did raise a lot of capital to go out and do acquisitions, because fundamentally it looks like it's a great opportunity, right? With that being said, they've had a lot of challenges, and we start to see some of the challenges here on this slide. Their funds from operation down to 68 cents on an annualized basis over the last quarter. They typically used to do, before the pandemic, 80 to 90 cents annualized in funds from operations, so down notably from that. They used to pay an 80-cent annual dividend. So that kind of goes to show how confident they were at staying over that 80-cent level and growing from there. And we're down here in the 60s. Net asset value, I think, hit close to $15. It was definitely 14.5-ish at one point. So that's down about 10%. Pretty notable drop there. Looking at some of their other metrics here, debt metrics. I typically like to invest in REITs that have around 40% or under debt as part of their kind of balance sheet. And you can kind of see here the debt metrics have just continually, this is quarter over quarter, going up very, very dramatically from 48% to 54% in a quarter. And then 2 quarters later, 56%. Now the next quarter, we're at 57%. I think this is one of the things that are scaring investors here. You can kind of see their fixed rate exposure is only about 60%, give or take. So over the last few years, as interest rates have gone from 2% to 7% in some parts of the world, that's really, really hit their ability to manage their debt and service their debt, and taken a ton of cash out of their funds from operations into making those debt payments, and has made it hard for them to pay down that debt. That's one component of what's going on here. The other is they haven't really been managing their business too conservatively over this time. This has been a very challenging time for the real estate industry and REITs. And as they have variable interest rates, as they have a high dividend payout with that 80-cent distribution, they were going out and making all kinds of deals, joint ventures, acquisitions with their business. One of those was their UK joint venture that they made. And this one had a notable impact on the stock a couple months ago, as I believe the partner, the institutional investor that they call out on this slide, ended up backing out of their agreement during due diligence. Whether it was a valuation issue, whether it was a debt issue, whether they couldn't get financing, it doesn't really matter. It just really put a lot of questions onto the company on the strategic direction they're going. Why weren't they able to get the partner that they previously announced? Now they have all this debt on this acquisition and whatnot. And in addition to there's lots of complexities on this REIT in terms of their variable interest rate exposure, their management fee side of their business. Now you have these joint ventures that they're investing huge amount of money into that aren't going through, and it just was not great timing for bad news. But I'd also argue that it's not great timing to be making huge strategic shifts in your company at a time that you should just be kind of battling down the hatches, making sure you're making your debt repayments, investing to reduce that debt if you're approaching 60% debt. So I'd argue they haven't really managed the business well, haven't managed their capital well, haven't managed the debt well. And that's one of the reasons why the stock price has kind of gone where it has, and the AFFO has also been trending down. So looking at just their business, at results from earlier this year, you can kind of get a general sense of the business. About, let's call it 25% of the business is management fee income. So they get that from like managing hospitals and whatnot in some of their joint ventures or for other owners. So EBITDA went up. This is a bit misleading because this company always launches or releases new shares as they keep doing huge acquisitions and whatnot. So try to take the absolute numbers with a bit of a grain of salt. Then you get down to the adjusted funds from operations, which is, at the end of the day, all that matters if you're a REIT. And that is down 15% here, so down $7 million. And that's on an absolute basis. So forget the dilution in the share price, which added another 5 points of hurt to that, or in the share base. But just organically down 15% on funds from operation. You're looking at the top, your NOI was 25% higher, and your funds from operation was 15% lower. That's a 40-point gap. And that just goes to show how I don't think they manage their interest rate very well, going down 150% from 20 million expense to 50 million expense on the quarter on interest rates. And usually with REITs, they shouldn't be speculating on interest rates. They don't know exactly what's going to happen. They should be locking in fixed rates, especially with rates that were as low as they were. There was no real excuse to have a variable interest rate exposure to this degree. And one watch out that I see when I look at REITs, at least personally, is when they share like target interest rates. This like weighted average interest rate. You have no idea what's going to be happening with interest rates. Why are you speculating that they're going to go down? If anything, that's going to exacerbate your problem. You're going to be taking out more variable debt that because you're assuming interest rates are going to go down. You should just be managing your variable debt and your fixed debt at face value. If you want 10, 20% variable, whatever, but they're not in the business of speculating interest rates. They're in the business of managing real estate, acquiring real estate at cap rates that make sense for the given interest rate environment. So I always see when I see things like this as a pretty big red flag in my opinion. The other thing is total current debt, $4 billion. I know they're planning some non-core asset sell-offs, but this is a huge change from the $2.5 billion they're targeting. Once again, this is a $1.2 billion company. These are huge debt numbers that they've racked up and huge debt payments that they're making on a monthly basis. So they've just gotten themselves in a huge hole here, moving way too fast, way too quick, not really dotting their I's and crossing their T's. Joint ventures not going through. It's just a bit of a crapshoot, to be honest, on this one, in my opinion. Now, unfortunately, but they had to do it. They had to announce some changes with the company just because of everything that we were just talking about. Joint ventures falling through, debt payments skyrocketing, NOI and funds from operations dropping down. So they did a strategic review and they made some announcements here. The one thing that they called out here is they're going to do some near-term non-core asset sales. They always call it non-core asset sales, but obviously lots of these assets are assets that they wish they could keep or they wouldn't have been acquiring them like crazy over the last few years. And then the second thing, and this is probably the most notable thing, change in the monthly distribution. Everyone knew that this was like going to happen. Their payout ratio or their payout was higher than their funds from operation. They obviously don't have a cash hoard on the company. They're piled in debt. So it was just a matter of how much they're going to cut the dividend. They cut the dividend from about 80 cents a share to 36 cents a share. So it was about, over 50%, about 60% cut in the dividend, give or take, which is a huge, huge slap to the investors in the company. But you know what? It's what had to be done to protect the company longer term. And hopefully the share of the equity long term will benefit from their ability to take more of their capital. Just pay down the debt, for God's sake. Stop with all of the other projects and initiatives they got going on. They clearly are not doing a great job of managing them. So that's this company overall. You can probably sense some of my frustration from going through those slides. It's painful for me to go through those slides. I'm down over 50%. So one of the benefits on this one is I have been collecting a pretty juicy dividend. Over the last year alone, I've gotten, or over the last couple years, I've gotten 80 cents a year. So I'm not really down over 50% because at these levels, 80 cents is like 15% a year. But it definitely has not been a stock that's given me a positive return here. And on this one, it's so many things going on with the company. We have so many complexities that when I first bought this company, I thought it was just going to be a pure play, own hospitals, let the NOI come in, pay it out as dividend. But they have gone in so many different growth areas or growth endeavors, trying to go asset light a couple years ago by getting more management fee income. When you sell an asset light business model, it usually doesn't involve 60% debt ratios and $4 billion in debt. So I don't know how they kind of went in that direction or communicated that direction, and now they're sitting on their debt load that they are. They've done huge acquisitions in the UK and Australia and in the United States at a time that most REITs are kind of backing off for a bit with the valuations and the interest rates where they are. They went full steam ahead, and obviously it hasn't been working. So on this one, I'm still holding it. I'm down huge, but I'm just going to be taking my monthly dividend. I'm not really investing more in it until some of these things at least clear up. Long term, they've said that they have a medium to long term, call it like 2026 objective of getting to $1 of funds from operation a year. If they actually do that, the company is a steal, trading at 5 times funds from operation. But I'm not overly confident based off of their recent performance, the fact they just had to cut their dividend, their strategy's a bit all over the place, that they're going to be able to achieve that. So I'm not necessarily doubling down on this one, but I do still think even at 70 cents funds from operation annualized, that this one is still pretty cheap in the high single digits funds from operation with interest rates where they are. And if interest rates go down, that's just going to get lower and lower on the current stock price, since they have so much exposure to variable interest or variable debt. So that's my overall thoughts on this one. Holding it for now. Definitely think there's upside and think it's undervalued, but I understand the frustration and why lots of investors have just dropped this one and moved on. I'm trying to be a bit more long-term. Hopefully it does rebound. In the meantime, I'll collect that 7% current dividend. But this has probably been my worst investment that I've made in my portfolio. Going into the second stock. The second stock is AT&T. AT&T here down 46%. You can see my average price on this one is at $27. $15 is where I'm currently at. And, you know, a bit of a nuance here is that they spun off Warner Brothers Discovery. So I got some value out of that. I don't think that's really incorporated in lowering my cost basis. But aside from that, this one has still not performed very well. Pays a 7.4% dividend yield. They cut the dividend when they split up from Time Warner. But this one I just think is fundamentally cheap. And we look at the market cap at $106 billion. This company is expected to do about $16 billion of free cash flow this year. So the company's trading at 6 to 7 times free cash flow levels. And even though they have some businesses that may not be in a great position, they also have some businesses that are doing just fine. So this is a summary of the last quarter. You can see here revenue is about flat, adjusted EPS about flat, cash from operations. I don't like to really take this into account quarter over quarter, but it's definitely not declining in a rapid way or anything like that. So the business overall looks decently healthy for a company trading at 6 to 7 times, in my opinion. One watch out that I didn't like to see is this is another company here. A common theme with these companies that have been getting absolutely tranched is the debt level. So net debt in second quarter of last year is $132 billion. Currently still $132 billion. I would have loved to see them pay off a bit more of this debt. And if you look at here, their expectations for the back half of the year, they're expecting $11 billion in free cash flow, still paying their dividend $5 billion, spectrum cost $2 billion. So they're going to use the remaining $4 billion to pay off debt. That's definitely would be like a good start, but I'd love to see that like consistently quarter after quarter paying off a few $1 billion, getting this down to a much more reasonable level. I know these telecom companies inherently have a lot of debt because of the capital expenses they need to incur, the just infrastructure they have to build out for the long-term health of their business and their services. But especially with interest rates where they are and investor sentiment around interest rates and not wanting companies with high debt, I think that's definitely knocked this stock down even farther than it deserves, in my opinion. That paired with just their poor management decisions over the last decade too, acquiring DirecTV, acquiring Warner Brothers, all of that stuff not working. They don't really get a premium multiple, and they don't really get the benefit of the doubt. One area of their business that I do like is their mobility division. I see interconnectedness with phones and people paying on a recurring basis for their cell phone plans to be a really strong business. You can kind of see here margins went up. The overall business went up a couple percent on revenue as well. And this is just one of the areas of the company that I feel really solid holding on to and owning, whereas their cable division, some of their other divisions may be a bit more challenging and may have a bit more headwinds in the future. The mobility business specifically is the one that I feel like will help ensure that we continue to have decent free cash flow moving forward, and they can start paying off that debt. They can keep paying off that 7.5% dividend. And as 5G comes up, hopefully there's new services that they can sell to consumers and really expand their revenues and whatnot as kind of cable goes out the window. So that's just a bit of my sentiment on AT&T. Looking at their EPS, which is actually pretty close to their funds from operations, which I prefer to look at for these telecom companies. It's at about $2.50. So you can do the math. $15 share price, $2.50 on EPS. They're trading at about 6 times. So At the end of the day, I get this isn't necessarily a growth company. They have some headwinds with cable, very competitive and commoditized other business segments. They have a pretty good business there with mobility. But overall, maybe not a growth company. With that being said, 6x earnings, 7.5% dividend yield, an essential service that's serving lots of America. I'll take that at 6x earnings. So this one's really just a valuation play. If this one got up to a much higher earnings multiple, I would probably exit the position. But it's really just, I feel like a discount to what the true net present value of the funds from operations are. Okay, this takes us to the third stock that I'm down bad in my stock portfolio, and it is Walt Disney. So this one, I actually haven't bought shares in Disney in a few years, and I'm still down 35%. My average price is 131 bucks. I think I had a decent position in Disney in the low 100s, and then I think I bought a bunch more, unfortunately, during the ramp up of the pandemic stock market when this one was kind of closer to 150, 160. That's how I got here at 131. Current stock price is at about $85, so I'm down 35% and an eye-watering 9,000 US dollars on this one. So this one has been just terrible. Haven't really got many dividends from it too. I got some before the pandemic. There's like a 1% yield. Looking at this one, it's trading near a 5-year low. If I look out longer term, the stock price in, as I go back here, if I bought the stock 8 years ago, pretty much, I would be down 19%. So even if I included the dividend in that, the 1 or 2% they were paying, you'd have a negative total shareholder return over 8 years. We're going to go through some elements of the company here today. They have 3 different kind of revenue or business units, rather, of their business. They call out the studios, parks and experiences, and then streaming. These are the 3 areas of growth that they really see in their business, and they're within other divisions that we're going to talk about here. Before we do that, we'll just take a look at their overall results for the last quarter. So about $22 billion in revenue, a couple percent growth is nice to see. When we go to operating income, stagnant at $3.6 billion. EPS, I'll look at excluding certain items for EPS, right there at around $1. So that's stagnant. So at the end of the day, increased revenue a few percent. Operating income was the same. EPS was a down 3 or 4%. So the company's not moving, not really going anywhere. But within the company, there is lots of movement, and we'll get to that in a minute. You can see here, linear TV has gone down dramatically in terms of the profit and revenue driver it is. And this is really important because streaming's still losing money. So as streaming's still losing money and they're investing tons of money into content, they need to make sure they're getting returns on those investments. And when you see linear going from 7.2 down $500 million year over year to 6.7, going down from 2.5 in operating income to 1.9, that is like a 23% decline in operating income in a year. So if next year that goes from 1.9 to 1.5, 1.5 to 1, it's going to just wipe out lots of the value that's here in the media entertainment distribution segment of the business. So they really need to get their direct-to-consumer business to break even really fast, and then very quickly after that, scale it to profitability. So as this linear networks, which is inevitably going to go down and down and down, as it goes down to 1.5, 1, they really need direct-to-consumer to make up for those lost operating incomes and offset it by going from negative 0.5 to plus 1, plus 1.5 to really pave the way for the future of the content side of the company here. Looking at D2C's quarterly operating loss. So this is a bit promising over the last number of quarters. And if we go earlier than this, it was getting crazy, billions of dollars a quarter. We kind of see here, it looks like it plateaued in Q4 of 2022. Fingers crossed that it doesn't go back there for Q4 of 23. But $1.5 billion, $1.1 billion in Q1, $700 million, $500 million. So let's hope we continue to get here to break even in the next few quarters. And then that'll be a huge milestone when they finally turn their D2C business from an operating income standpoint positive. But just looking here, this is just about 5 quarters. So this is like 15 months of operating their D2C business, down 3.7, 4.5, down $5 billion. $5 billion of loss in 15 months of operating a business that they invested a lot of money into. You can do a lot with $5 billion, okay? You can buy content, you can pay down debt, you can almost open new parks, you can make cruise ships. There's so much that you can do with $5 billion, especially right now in the economy with money being as hard as it is to get and as expensive as it is. So this is a huge, huge, huge investment. They've really betting a pillar of the company on this turning positive and scaling up in a big way. So this is a big component of if you're investing in Disney at these levels in the 80s at around $150 billion value. This is one of the things that you think is going to do well to very well long term. If you don't think this is going to work with linear going the way it is, it's a tough stock to buy and a tough stock to model out in terms of the value that they're currently trading for, even at these lower levels, historically speaking. I just wanted to flag this on the screen because, Disney made a huge acquisition in buying Fox, 21st Century Fox, in I think it was 2019. It was a huge investment, $70 billion, okay? I think it goes without saying that it was not worth the price they paid for it, okay? Especially when you look at the value of Warner Brothers Discovery today for that content and whatnot. $70 billion is way too much money for what 21st Century Fox provided them. And one of the benefits of 21st Century Fox, they kind of talked about the streaming benefits and whatnot of having that much more content. But one of the things that was really going to be driven by 21st Century Fox was the studio. They were combining two of the world's largest studios, and the sentiment from investors is like every hit or every other hit that happens in the theaters globally is going to be between Disney and 21st Century Fox. They're going to own almost a monopoly on the theatrical releases. And they just have not. They've had a couple wins, but if anything, I feel like Disney was having a much more productive and much more consistent winning record at the box office before they made the $70 billion acquisition. So this is one thing that I think has disappointed for sure as part of that deal. In addition to like streaming values not necessarily panning out to the extent that they hoped. Just looking down the list over the next few years, sure, there are some great shows here and things that are going to make a lot of buzz, but it's not necessarily blockbuster after blockbuster after blockbuster. And this is kind of what they're the best of the best that they're showing us between now and middle of next year. So, I think that's probably disappointed a bit in the studio side of things. I know obviously during the pandemic it was hard to get the studio business rolling, but now that we're out of the pandemic, they've had a lot of time before the writers' strike, before the actors' strike, to get out some great content and some great stories, and I don't think they've really met expectations there. I'm going to close on Disney just looking at some of their operating results here. So we looked at the linear networks briefly. You can kind of see direct-to-consumer here. Year to date, last 9 months, has lost $2.5 billion, okay? Linear networks has brought in 6.7, down 27%. So the whole company, as far as the content and the media side, is completely contingent on linear networks, which is an absolute free fall. So I think that's really scary for lots of the investor base here. Also, subscribers. I know subscribers aren't the end-all be-all, but you can kind of see it's really flatlined, and that would be okay if the ARPUs were going up, but that's also flatlined as well. So hasn't been growing to the same extent as it was before. And I hope that they still have a plan through synergies and back-end stuff and future pricing to get the profitability on streaming. Because if they don't get the profitability on streaming and linear networks continues in free fall, we have a bit of a recession and the parks aren't as hot as they have been recently, then this company potentially has even farther down to go here. Just wanted to look at some of the parks business that they have up here. The parks business has really been what has been leading this company forward. You can kind of see the revenues here, $24 billion. They are a growth of 17%. $7 billion of operating income, up 20%. Huge numbers. And the whole company is kind of relying on the parks to be that stable cash cow as linear's in free fall, as they invest in some of their growth businesses. So hopefully the parks hold up well. The company's really counting on it, but it's definitely on shaky ground here. Looking at their earnings per share, this year they're expected to do $3.70, so trading at about 24 times, 25 times current year earnings. Next year, closer to $5, so trading about 18 times next year if they actually pull that off. So my overall thoughts on Disney, you saw at the beginning, I have about 200 shares in Disney, so pretty darn big position for me in this company. I think it's really challenging right now. It's challenging to compete against all of the big tech companies coming into the entertainment space, not necessarily requiring the same return on investments, packaging entertainment and content for their entire bundles. Think about Amazon just wanting retention on Prime and things like that. It's extremely hard to compete with that. So this is one that I think is going to continue to be really challenging for them to win on. And it'll be really interesting to see how they manage it. I think if any traditional media company does win and does build out a strong business model in this new world of media, that they can get strong total returns on investment and share appreciation, I do think it will be Disney. I think Disney's best positioned. They're pretty well diversified. They've invested a lot in streaming, so if that does take off, they should be in a good spot. They have the parks business. They have all these other things going on as well. So I do think out of the traditional media companies, think like Lionsgate, Warner's Brother Discovery, Disney, there's a few more of them, Comcast and whatnot. I do think Disney's best position, but I think the whole space, I wouldn't be surprised if they lag the market over the medium term with Apple, Amazon, Google, all these people buying sports rights, moving into entertainment, Netflix continuing to strive. It's just a really, really crowded, competitive space, and they've definitely been disrupted in a big way, and you see it in the stock price, you see it in the results. So this is one that I'm going to hold my position here, but I don't really have any appetite to invest more until I start to see a few things. I want to see streaming continue to glide path towards profitability. I actually want to see them hit profitability for a few quarters in a row to know that that's a business they can keep investing in and deliver shareholder return on longer term. I want to make sure the parks can sustainably deliver this level of profitability and not necessarily this level of growth, but I want them to be able to deliver those billions of dollars of free cash flow and operating income to enable us to invest in these other areas of the company. I also want to see what happens with ESPN. There's been lots of talk on what they're going to do with ESPN and Hulu. They have the option to buy Hulu in, I think, January of next year. It looks like they're going to do it, but I want to see what that looks like, how much they pay for that, how they manage their debt in this process, if they reignite their dividend that they said they were going to do this year. It's so many things going on that I'm just kind of taking a passenger seat on this one, and we'll see how it goes over kind of, let's call it the short to medium term. But similar to the last few years, I'm going to watch this one from the sidelines, not going to buy any more of this company. So these are my 3 worst performing stocks. Hope you guys liked me going through these, showing you how much money I've lost on them, and just some of my thinking behind these 3 names. Let me know in the comments if you own any of these stocks or if you have any thoughts on them. And if you made it to the end of the video, be sure to give me a thumbs up and also let me know in the comments. Not too many people make it to the end, so I do appreciate it. If you like this kind of content, be sure to also subscribe to the channel, and I'll see you guys in the next one. Thanks.